Canada's housing market was once considered one of the hottest in the world, but now, shocking new estimates suggest that many Canadian homeowners are effectively losing around $5,000 in property value. Every single day as prices rapidly correct across the country, homes that once sparked fierce bidding wars are now sitting on the market for weeks, sometimes months. And in some cities, property values have already dropped by tens or even hundreds of thousands of dollars. For many families, the biggest investment of their lives is suddenly becoming their biggest financial worry. Just a few years ago, people believed Canadian real estate could only go up. Interest rates were low, investors were rushing in, and buyers were willing to pay almost anything just to secure a home. But now the situation has flipped. Mortgage payments are exploding, buyers are disappearing, and thousands of homeowners are realizing that the market they trusted might have been built on a fragile foundation. So what exactly caused this dramatic shift? And why are experts warning that the real impact may just be beginning? In this video, we'll break down the 10 shocking reasons behind Canada's housing crash and what it could mean for homeowners, buyers, and the entire economy. Number 1. Interest rate shock. One of the biggest reasons Canada's housing market is suddenly shaking is something most people rarely paid attention to during the boom years: interest rates. For more than a decade, borrowing money in Canada was incredibly cheap. Banks were offering mortgages with historically low rates, which meant buyers could afford much larger and more expensive homes. This easy access to money fueled intense competition, pushing home prices to record highs across cities like Toronto and Vancouver. But everything changed when inflation started rising rapidly. To control the economy, the Bank of Canada began aggressively increasing interest rates. And these increases didn't just rise a little. They jumped, faster than many homeowners had ever experienced before. Suddenly, the cost of borrowing money skyrocketed. Here's where the real shock begins. When interest rates rise, the amount of money buyers can borrow drops dramatically. A family that once qualified for a $900,000 mortgage may now only qualify for around $650,000 or even less. That's a massive difference. And when buyers can afford high prices anymore, the entire housing market starts to cool down. For existing homeowners, the pressure is even worse. Many Canadians have mortgages that renew every few years. This means people who locked in low rates during the boom are now facing much higher monthly payments when their mortgage renews. Imagine your payments suddenly increasing by $1,000 or even $2,000 per month. For many families, that's simply not sustainable. As buyers step back and homeowners feel the financial squeeze, demand weakens while more properties begin entering the market. And when demand falls but supply increases, prices start to slide. What once looked like a never-ending housing boom suddenly turns into a market correction that can wipe out thousands of dollars in home value almost overnight. CTA. Before we move to the next reason, we'd love to hear your thoughts. Do you think Canada's housing crash will get worse or recover soon? Drop your opinion in the comments, because we truly read them all. And if you enjoy content like this, please subscribe to the channel. It's just one click, but it helps us continue making these in-depth videos for you. Number 2. The pandemic housing bubble. To truly understand why Canada's housing market is struggling today, we need to go back to the pandemic years, when the real estate market experienced an explosive surge. During COVID-19, governments and central banks around the world introduced massive financial stimulus to support the economy. Interest rates were pushed to extremely low levels, and borrowing money became easier than ever before. With cheap loans available, thousands of Canadians rushed to buy homes. At the same time, remote work changed how people thought about living spaces. Suddenly, many families wanted bigger houses, home offices, and properties outside crowded city centers. This sudden shift created a massive spike in housing demand, almost overnight. But demand wasn't the only thing driving prices up. Something else was quietly fueling the market: fear of missing out. Often called FOMO, buyers began believing that if they didn't purchase a home immediately, prices would rise so fast that they would never be able to afford one again. This mindset triggered intense bidding wars across the country. Homes were selling in hours instead of weeks, sometimes with 15 or even 20 competing offers. As a result, prices started rising at a speed that far exceeded normal economic growth. In many areas, home values jumped 30%, 40%, or even more within a short period of time. The problem is that wages, population growth, and economic fundamentals simply couldn't keep up with this surge. In other words, prices were rising far beyond what the market could realistically support. This is what economists often call a housing bubble, a period when asset prices become disconnected from their true underlying value. And history shows that when bubbles expand too quickly, they eventually face a correction. Now that borrowing costs are rising and demand is cooling, the market is beginning to adjust back toward reality. And when a bubble starts to deflate, the correction can feel sudden, dramatic, and painful for homeowners who bought near the peak. CTA, quick question for you. Did you or someone you know buy a home during the pandemic boom? Share your experience in the comments. We genuinely read them and love hearing your stories. And if you appreciate the effort we put into breaking down complex topics like this, take 1 second to subscribe to the channel. It's just one click, but it helps us keep creating videos like this for you. Number 3. Canada's massive household debt. Another major reason behind Canada's housing troubles is something that has been quietly building for years: record-breaking household debt. During the housing boom, millions of Canadians borrowed heavily to enter the property market. With interest rates extremely low, taking on large mortgages seemed manageable at the time. Many buyers stretched their budgets, believing that rising home prices would continue to protect their investment. But the problem with high debt is that it becomes extremely dangerous when economic conditions change. And that's exactly what's happening now. Canada has one of the highest household debt levels among developed countries, meaning many families owe more money relative to their income than ever before. When interest rates were low, monthly mortgage payments were relatively affordable. But once rates started climbing, those same debts suddenly became much more expensive to manage. For homeowners with variable rate mortgages or upcoming renewals, monthly payments are rising dramatically. In some cases, families are seeing their mortgage costs increase by hundreds or even thousands of dollars per month. This puts enormous financial pressure on households. When a large portion of income goes toward debt payments, people have less money left for savings, daily expenses, or emergencies. And when financial stress builds, some homeowners are forced to make difficult decisions, such as selling their property sooner than planned. As more homeowners struggle with higher payments, more homes begin entering the market. At the same time, potential buyers are becoming more cautious because they don't want to take on huge debts in an uncertain economy. This combination creates a dangerous cycle where high debt levels weaken demand while increasing supply. In simple terms, Canada's housing market wasn't just built on rising prices. It was built on massive amounts of borrowed money. And when the cost of borrowing rises, the entire system begins to feel the pressure. CTA. Now we're curious about your opinion. Do you think household debt is the biggest risk to Canada's housing market, or is something else to blame? Drop your thoughts in the comments. We read every single one. And if you value the research and effort behind these videos, take 1 second to subscribe to the channel. It's just one click, but it helps us keep bringing you powerful insights like this. Number 4. Investors are leaving the market. For years, a huge portion of Canada's housing boom wasn't driven by families looking for a place to live. It was powered by investors chasing profits. Many people saw real estate as the safest and fastest way to build wealth. As home prices kept climbing year after year, investors began buying multiple properties, expecting that prices would continue rising almost indefinitely. Some purchased homes to rent out, while others simply bought properties to sell them at a price. This wave of investor activity created even more competition in the market. Regular home buyers suddenly found themselves bidding against professional investors with deeper pockets and greater risk tolerance. As a result, prices continued to climb faster and faster. But investor behavior can change very quickly when market conditions shift. And that's exactly what is happening now. Rising interest rates have made it far more expensive to finance investment properties. Mortgage payments have increased, while profits from rising home values have slowed, or in some cases, completely reversed. At the same time, many investors are realizing that the risk of falling prices is now very real. When investors begin to believe the market may decline, their strategy changes almost overnight. Instead of buying more properties, they begin looking for opportunities to sell and secure their profits before prices fall further. This shift creates a powerful ripple effect. As investors exit the market, the number of homes available for sale increases, but at the same time, fewer investors are entering the market to buy those properties. That means supply grows while demand weakens, a combination that can accelerate price declines. Housing markets often rely heavily on confidence and momentum. When investors believe prices will rise, they pour money into the market. But when that confidence disappears, the same investors can quickly become sellers, pushing the market in the opposite direction. We're really curious about your perspective. Do you think investors helped create Canada's housing bubble, or were they simply reacting to the market? Share your thoughts in the comments. We genuinely read them all. And if you appreciate the effort we put into researching and explaining topics like this, take 1 second to subscribe to the channel. It's just one click, but it means a lot and helps us keep making these videos for you. Number 5. Mortgage renewals are turning into a financial shock. One unique feature of Canada's housing system that many people outside the country don't realize is how mortgage renewals work. Unlike some countries, where homeowners can lock in a mortgage rate for 20 or 30 years, most Canadian mortgages renew every 3 to 5 years. This system works smoothly when interest rates remain stable, but when rates rise sharply, it can create a massive financial shock for homeowners. During the housing boom, millions of Canadians locked in mortgages at incredibly low rates, sometimes below 2%. At the time, monthly payments were manageable, and buyers felt confident about stretching their budgets to purchase expensive homes. But now, those same homeowners are reaching the end of their mortgage terms and are being forced to renew at dramatically higher rates. And the difference can be shocking. A homeowner who once paid around $2,000 per month could suddenly face payments of $3,000 or even $3,500 after renewal. That's not a small increase. It's a huge jump in monthly expenses. For many families already dealing with rising food prices, fuel costs, and inflation, this sudden financial pressure can feel overwhelming. Economists sometimes call this situation a mortgage renewal cliff. Over the next few years, a large wave of homeowners will face these higher rates as their mortgages come up for renewal. Each renewal forces families to reassess their finances and decide whether they can truly afford their homes under the new conditions. If even a small percentage of these homeowners decide, or are forced to sell, it could add thousands of additional properties to the market. At the same time, potential buyers are struggling with higher borrowing costs, which limits how much they can afford. When more homes hit the market but fewer buyers can afford them, prices naturally begin to fall. In other words, the mortgage renewal cycle could become one of the most powerful forces pushing Canada's housing market downward. CTA, let us know what you think. Would you still buy a home today knowing mortgage rates could change in just a few years? Share your thoughts in the comments. We love hearing your perspectives, and if you appreciate the time and effort we put into creating videos like this, please take 1 second to subscribe to the channel. It's just one click, but it helps us continue bringing you valuable insights. Number 6. The condo market is starting to crack. Another important piece of Canada's housing puzzle is the condo market, and right now, it's beginning to show clear signs of stress. During the housing boom, condos became one of the most popular investments in major cities like Toronto and Vancouver. They were often seen as the entry point into real estate, because they were cheaper than detached houses and easier to rent out. This attracted a massive wave of investors. Many buyers purchased condos not because they planned to live in them, but because they expected rising property values and steady rental income. In fact, in some cities, investors made up a huge percentage of condo buyers. As long as prices kept rising and rents stayed strong, the strategy worked well. But the situation is changing quickly. Rising interest rates have increased the cost of financing condo purchases, which means investors are now paying much higher mortgage payments. At the same time, new condo buildings that were planned during the boom years are finally being completed. This means thousands of new units are suddenly entering the market. When supply increases rapidly, prices and rents can come under pressure. Some investors are now discovering that the rent they collect may not even cover their monthly mortgage and maintenance costs. This creates a difficult situation where owners must either absorb the financial loss or consider selling their property. And when many investors begin thinking about selling at the same time, the market can shift quickly. Condos often react faster to market changes than houses because they are heavily influenced by investor activity. If investor demand weakens while new condo supply keeps growing, prices can start falling faster than expected. This is why many analysts believe the condo sector could become one of the first areas to show major cracks in Canada's the housing market, CTA. Now we want to hear from you. Do you think condos are still a good investment, or has the risk become too high? Share your thoughts in the comments. We read every single one, and if you enjoy deep dives like this, please take 1 second to subscribe to the channel. It's just one click, but it helps us keep producing these well-researched videos for you. Reason 8. Economic uncertainty is freezing buyers. Another powerful force slowing down Canada's housing market is economic uncertainty. When the future of the economy feels unclear, people naturally become more cautious with big financial decisions, and few decisions are bigger than buying a home. Over the past few years, Canadians have been facing a wave of economic pressures. Inflation pushed the cost of everyday essentials, like food, gas, and utilities, to much higher levels. At the same time, companies in several industries began announcing layoffs, particularly in sectors like technology, finance, and real estate. Even people who still have stable jobs are starting to worry about what could happen next. When uncertainty rises, consumer behavior changes quickly. Instead of rushing into major purchases, people start delaying them. Potential homebuyers begin asking themselves tough questions. What if interest rates rise again? What if my job becomes unstable? What if housing prices fall further after I buy? These fears can dramatically slow down housing demand. Buyers who once felt pressure to purchase immediately are now choosing to wait on the sidelines. They want to see where the market is heading before committing to a massive long-term mortgage. This shift in mindset has a major impact on the housing market. Real estate prices depend heavily on buyer confidence. When buyers feel optimistic, demand rises and prices increase. But when confidence weakens, demand can disappear surprisingly fast. Sellers are then forced to adjust. Homes stay on the market longer, bidding wars disappear, and price reductions start becoming more common. Even a small drop in buyer activity can ripple through the market and cause noticeable price declines. In simple terms, uncertainty acts like a brake on the housing market. When people feel unsure about the economy, they stop rushing into purchases, and that pause alone can push the market into a correction. CTA. Now we want your opinion. Would you buy a home right now, or would you wait to see where the economy goes next? Tell us in the comments. We truly enjoy reading your perspectives, and if you appreciate the effort and research behind these videos, please take a second to subscribe to the channel. It's just one click, but it helps us keep creating content like this for you. Number 9. Government policies are cooling the market. Government policies have also played a major role in slowing down Canada's once booming housing market. Over the past few years, policymakers have introduced several measures aimed at controlling speculation. While these policies were designed to stabilize the market, they have also contributed to reducing demand and cooling housing activity. One major policy change was the introduction of foreign buyer restrictions and taxes in several provinces. These measures were meant to reduce overseas investment that many believed was driving up home prices in major cities. While the goal was to make homes more accessible for local buyers, the reality is that removing a group of high-spending buyers from the market naturally reduces overall demand. Governments have also implemented vacancy taxes and speculation taxes to discourage investors from leaving properties empty. These policies push owners to either rent out their homes or sell them. While this may increase housing availability, it can also lead to more properties being listed for sale at the same time. Another important factor is the mortgage stress test, which requires buyers to prove they can still afford their mortgage even if interest rates rise. While this rule helps prevent risky borrowing, it also means many potential buyers simply don't qualify for large loans anymore. Each of these policies may seem small on its own, but together they create a powerful impact on the housing market. When regulations tighten, investor activity slows, borrowing becomes more difficult, and fewer buyers can enter the market. And when demand weakens while supply gradually increases, prices naturally start adjusting downward. In many ways, government policies are acting like a cooling system for an overheated market, slowing the pace of growth and pushing housing prices back toward more sustainable levels. CTA. Now, we'd really like to hear your perspective. Do you think government policies are helping fix the housing problem or making the situation worse? Share your thoughts in the comments, because we genuinely read them all. And if you appreciate the effort we put into researching and creating these videos, please take a second to subscribe to the channel. It's just one click, but it helps us continue making content like this for you. Number 10. The psychology of a market crash. One of the most powerful forces behind any housing market, yet one of the least talked about, is human psychology. Real estate markets don't move based only on numbers, interest rates, or policies. They are also driven by people's emotions, expectations, and beliefs about the future. During the housing boom, confidence was incredibly high. Many Canadians believed home prices would continue rising forever. This belief created a powerful cycle. As prices went up, more buyers rushed into the market because they feared being left behind. This phenomenon is often called FOMO, the fear of missing out. Buyers were willing to stretch their budgets, waive inspections, and compete in intense bidding wars just to secure a property. The belief that prices would always rise pushed the market even higher. But psychology works both ways. When the market begins to slow, confidence can disappear surprisingly fast. Instead of fearing that they might miss out, buyers begin to worry that prices might fall even further. This creates a completely different type of behavior. Instead of rushing to buy, people decide to wait. And when buyers wait, demand suddenly drops. At the same time, sellers begin feeling nervous. If homeowners believe prices may decline further, many try to sell quickly to protect their equity. When more sellers enter the market while buyers hesitate, prices start sliding faster. This shift in sentiment can turn a small correction into a much larger market downturn. In many cases, the psychology of fear spreads faster than any economic data. Housing markets rely heavily on confidence and momentum. When confidence is strong, markets rise. But when fear replaces optimism, even a small decline can trigger a powerful chain reaction that pushes prices down across the entire market. CTA. Now we'd love to know what you think. Do you believe Canada's housing market will recover soon, or is the crash just getting started? Share your thoughts in the comments. We truly enjoy reading your insights. And if you appreciate the effort we put into creating these videos, please take a moment to subscribe to the channel. It's just one click, but it helps us continue making valuable content for you. When you step back and look at the full picture, Canada's housing situation isn't being driven by just one single problem. Instead, it's the result of several powerful forces colliding at the same time. Rising interest rates, massive household debt, investor pullbacks, mortgage renewal shocks, increasing housing supply, and changing buyer psychology have all combined to create what many experts now describe as a perfect storm for the housing market. For years, the belief that Canadian real estate could only move upward pushed prices to levels that many economists warned were unsustainable. Cheap borrowing, intense competition, and investor speculation created a market where homes were often selling far above their true economic value. But markets always move in cycles, and when conditions change, even the strongest booms can quickly reverse. That doesn't necessarily mean the entire system will collapse, but it does mean the market is going through a major adjustment phase. Some homeowners may face financial pressure, especially those dealing with higher mortgage payments or upcoming renewals. Buyers, on the other hand, may start seeing opportunities appear as prices cool and competition decreases. What happens next will largely depend on several key factors: future interest rate decisions, economic stability, job growth, and how confident buyers and investors feel about the market moving forward. Housing markets rarely move in a straight line, and the coming years could bring both challenges and new opportunities. The most important thing to remember is that real estate is influenced by long-term economic forces, not just short-term headlines. Understanding the reasons behind market changes helps people make smarter financial decisions, instead of reacting purely out of fear or hype. And right now, Canada's housing market is at one of the most important turning points it has seen in decades.